Ladies and gentlemen, good day and welcome to Max Healthcare Institute Limited's earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Suraj Digavlekar from CDR India. Thank you, and over to you, Suraj.
Thank you, Michelle. Good morning, everyone, and thank you for joining us on Max Healthcare's Q3 and 9M FY24 earnings conference call. We have with us Mr. Abhay Soi, Chairman and Managing Director, Mr. Yogesh Sareen, Senior Director and Chief Financial Officer, and Mr. Keshav Gupta, Senior Director, Growth, M&A, and Business Planning. We will begin the call with opening remarks from the management, following which we will have the forum open for an interactive Q&A session. Before we start, I would like to point out that some statement made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Abhay to make his opening remarks.
A very good morning to everyone and a warm welcome to Max Healthcare's earnings call for the third quarter. This quarter has been exceptional for us, primarily for two reasons. First, it represents our 13th consecutive quarter of year-on-year growth. We recorded a healthy increase in network revenue and EBITDA by 14% and 12% respectively. And more importantly, we managed to grow ARPOB and EBITDA per bed sequentially despite Q3 being a seasonally lean quarter. Second, this quarter marks our foray into central UP, which is one of the most populous and fast-growing states in the country, through the acquisition of 550-bed Sahara Hospital in Lucknow. This acquisition will fortify our presence in northern India and is in line with the articulated strategy of entering new markets where peers have demonstrated success. We expect to consummate the transaction in Q4 and are ready with a plan of action to improve the infrastructure, augment the operational bed capacity, add to the existing medical talent, as well as integrate the hospital with the IT systems. On the clinical front, we have launched the CAR T-cell therapy at Max Vaishali in collaboration with ImmunoAct. Also known as a living drug, this groundbreaking therapy is expected to enhance the quality of life for many patients and reflects our continuous endeavor to provide our patients with the latest therapeutic options for cancer treatment. Now coming to the highlights of Q3 performance. Occupied bed days dipped marginally by around 1% year-on-year due to lower prevalence and spillover of vector-borne diseases in this quarter compared to last year. Average occupancy for the network was 73%. Institutional bed share at 29.5% compared to 29.4% last year and 27.3% in Q2 this year. However, after excluding Max Shalimar Bagh, the overall institutional bed share stood at 27.4% during Q3, and occupied bed days were down by 8% for this segment. Sequential increase in institutional bed share was a conscious call taken owing to Q3 being a seasonally weak quarter on occupancy. Average revenue per occupied bed for the quarter improved to Rs 76,800, growing by 15% year-on-year and 3% quarter-on-quarter. Year-on-year improvement was witnessed across all specialties, with oncology, neurology, and renal sciences being the key drivers. Network gross revenue was around 1,779 crores compared to 1,559 crores in Q3 last year and Rs 1,827 crores in the previous quarter. This reflects an increase of 14% year-on-year, driven mainly by growth in ARPOB. Revenues declined by 3% quarter-on-quarter due to festive season in Q3 and vector-borne diseases led jump in admissions during Q2. Revenue from international business grew significantly by 25% year-on-year. This payer channel now accounts for around 9.4% of the total revenue from our hospitals. Network operating EBITDA stood at 471 crores, reflecting a growth of 12% year-on-year and a decline of 5% quarter-on-quarter. Most importantly, annualized EBITDA per bed rose to a highest ever of rupees 75.6 lakhs, clocking a growth of 13% year-on-year and 1% quarter-on-quarter. Operating EBITDA margin stood at 27.9% for the quarter. Year-on-year growth in EBITDA was impacted due to additional charge of rupees 25 crores driven by movement in provision for doubtful debts, reversal of provision for old phantom stock option plan in Q3 last year after launch of the new ESOP scheme in November 2022, GST impact of variable management fees and one-time litigation cost. Max Shalimar Bagh, where we added 122 beds, recorded year-on-year growth of 36% and 42% in its revenue and EBITDA respectively, with an average occupancy of 74%. Profit after tax was rupees 338 crores versus 269 crores in Q3 last year and at the same level as in the previous quarter. Year-on-year improvement of 26% was primarily attributable to flow-through of improved EBITDA and lower finance costs. Free cash flow from operations generated this quarter amounted to rupees 226 crores after additional outlay of 40 crores for purchase of robotic systems at 4 of our hospitals. Of this, rupees 137 crores was deployed towards the ongoing capacity expansion project and 97 crores was distributed as dividend. Net cash position improved to rupees 1,295 crores at the end of December 2023 compared to 372 crores same time last year. Continuing our efforts to support the local communities, we treated approximately 36,700 patients in OPD and 1,250 patients in IPD from economically weaker sections of society, absolutely and entirely free of charge. Both our strategic business units continue to maintain their growth momentum. Max at Home reported a top line of rupees 44 crores, reflecting a strong growth of 24% year-on-year and 5% quarter-on-quarter. We continue to witness good demand for the SBU services as demonstrated by over 50% repeat transactions by patients in the last 1 year in our home care service alone. Max Lab, the non-captive pathology vertical, now offers its services in 41 cities and has a network of over 1,000 collection centers and active partners. This SBU reported a gross revenue of rupees 34 crores, reflecting a growth of 20% year-on-year. On the status of our expansion projects, Dwarka, for the 300 beds. As informed previously, application for occupancy certificate was submitted in October. Finishing is under progress. In the meanwhile, we already have the unit head and all other key functional heads in place. We have commenced hiring for middle-level staff as well. For the 329 beds at Nanavati, basement and ground-level structures have just been completed, while steel fabrication above ground floor has begun. The project continues to be largely on schedule. For 300 beds at Sector 56 Gurgaon, approval for structural drawing has been received in the first week of Jan and RCC works have already commenced. 190 beds at Mohali, design development is under finalization. In the meanwhile, the base raft concrete activities have started. Both these are largely on schedule. 350 beds at Max Smart at Saket Complex. Tree transplantation work is underway with 159 trees transplanted and balance 316 trees in process for transplantation. As per plan, existing structures have been demolished and shoring work for sewage and water treatment plants is going on. Barring the initial delay of 6-7 months, the project is on schedule now. For 300 beds at Max Vikrant at Saket Complex, the building plans have been resubmitted to the municipal corporation post their initial review, and water and sewage infrastructure, there were some payments to be made that has been paid and that has been connected. Tender documents are underway for floating to contractors. Application for NOC by Forest Department has also been filed. For 250 beds at Patparganj, the Fire Department issued NOC for the building plans and municipal corporation approval is in progress. All projects continue to be largely on schedule despite some disturbances linked to enforcement of GRAP, which is the Graded Response Action Plan in NCR to combat air quality issues. Finally, moving on to the overview of the company's performance for the 9 months ended December 31, 2023. Network gross revenue stood at 5,325 crores, reflecting a growth of 16% year-on-year. Network operating EBITDA grew by 17% year-on-year to rupees 1,404 crores. Increased ARPOB, improved case mix and augmentation of network bed capacity by 146 beds translated into improvement in EBITDA per bed by 15% to rupees 73.8 lakhs per bed. During the 9 months, we generated rupees 924 crores of free cash flow from operations after interest, working capital changes and routine capex, of which rupees 265 crores has been deployed towards ongoing expansion projects and rupees 97 crores was distributed as dividend. With this, we open the floor for question and answers.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may please press star and 1 on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Damayanti Kerai from HSBC Securities and Capital Markets. Please go ahead.
Hi, good morning, and thank you for the opportunity. My first question is on this institutional tariff revision, which we saw in the month of December. So, you mentioned there will be net loss of around 6 crore annually. Is this like ongoing? And just want to understand if this wouldn't have happened, the net gain which you mentioned for third quarter, 14 crore, should we have added this 6 crore back, like 14 plus 6, if the PET prices were not declined?
No, Damayanti, so basically 14 crores is for the quarter, right? So that's the run rate. That run rate also has some impact of this price revision which happened in the month of December, right? So around 1 week impact is already coming there. So 6 crore number is the annualized number, 14 crore number is a quarterly number. So I think now you can do what you want to do.
Okay, and
yes, coming to the question, if you didn't have the 6 crore, then you would have added back to this EBITDA. You would have added to this EBITDA. Not for this quarter, for the whole year. 1.5 crore.
1.5, okay. And do you expect any further revision in tariffs for this channel, or do you think like now government is broadly done and we might not see any additional revision?
We are expecting a revision in tariffs. Even this PET-CT thing, we think, which has been erroneously done, we've made representations, so we are in talks with them to revise it.
Okay, so further can come, right? And then that should be like maybe beneficial to our
that's right.
institutional channel.
Even I expect this, hopefully this PET-CT should get revised, because it went the other way. We believe it was an error.
Okay. That 10,000 going to some 11,500 or something, right?
No, so Damayanti, the tariff for the PET-CT had come down by around 50%, right? From 22,500 to 11,000 something. So it is 50% reduction, and that's major impact because oncology happens to be a big share of revenue for us, and so that was a 10 crore impact for the PET-CT. The cardiac had gone up by around 4 crores, so net impact is 6 crores, right? And that's all annualized numbers I'm talking.
Okay, understood. And Abhay, I guess a few quarters back you talked about this Heal in India initiative, which should be giving good boost to your international business. So any update on that front or any discussions ongoing around that initiative? Which you
I know, they haven't done a big bang as it was expected. What they've done is, there's a lot of movement in the embassies and so on and so forth. They're fast-tracking medical visas. They've taken off those policies of reporting to police stations. They're they brought down the price of the medical visas and generally promoting it globally. In the government of India is participating in various medical tourism forums and so on. And this is, right now it's leading to a trickle effect. Trickle effect meaning it's growth of 25%. Some manner it is not, but given the size of the opportunity, it's not exponential. It's still incremental, right? At a 25% CAGR on this.
Okay. And from Max perspective, right now it's around 9.4% revenue contributed by international patients. How much it can go up in, say, next 3 years, even if like, we don't hear any big changes by the government and these kind of small or I'll say regular improvements
It's
happen?
going at 25% CAGR. I mean, it's not this quarter. Last quarter was the same. The previous quarter was the same. I think last 5-6 quarters has been at this. I mean, I don't really see it abating.
Yeah, so Damayanti, if the overall growth is 14% and this channel is growing 25%, obviously the share should go up, right, going forward.
Yeah, got it. And my last question is, as you mentioned, oncology is a big focus for you, and you have been investing in this segment. So, which are, I'll say, key growth opportunities as per Max focus, and then what kind of expectation you have from this segment in terms of addition to your hospital revenues over next few years?
No, so I think, there are within the three streams really of oncology. You've got surgical, you've got medical, you've got radiation. I think there are various sort of innovations happening within these three itself. If you look at surgical purely, more and more robotics, so it's better ALOS, it's better outcomes, and but it's at the same time the percentage margins are lower, but absolute value to hospitals is more because in terms of the EBITDA per bed that you're able to derive from that is higher than what you do for a normal oncology surgery, and that number sort of doubled over last year. So I mean, we are seeing major growth in these. Now, similarly, if you look at radiation, okay, from a typical LINAC, you've gone into now various kind of these things and so on and so forth. But there have been other kind of innovations within the medical oncology as well. But now you're also looking at immunotherapy. Like we mentioned that we started CAR T cells. So this is another stream altogether. It's a sub-segment of chemo, but nevertheless, and globally, I think, it's a little expensive right now, and we are seeing prices come down, so adaptability of that is going to be a lot more. But that's what the world is moving towards in oncology, right? Is immunotherapy now.
Understood. Thank you for your answers.
Thank you.
Thank you. The next question is from the line of Harith Ahmed from Avendus Spark. Please go ahead.
Good morning. Thanks for the opportunity. My first question is on the recently acquired Lucknow hospital. So currently we have around 250 operational beds there, and we've talked about a capacity of 550 beds. So can you share your thought process in terms of taking the operational bed count higher, more towards the capacity bed count?
So what is, one is the amount of area which has already been constructed. It's about close to 1 million square feet. Number of beds operational are 285. So, there's obviously an opportunity. You can ramp up to the 550 as intended originally within this. The facility has been ignored for a while, so I think we are going to be changing the equipment and, we have to sort of redo the infrastructure. When I say redo the infrastructure, it's basically internal renovation which needs to be done. This is a brand new building made by L&T, Hafiz Contractor Construction, started in, I think, 2010, 2011. So it's not an old structure, but, of course, you need to, kind of renovate it. So I think within a couple of years, we should be at that 550 mark, number of beds mark, and, perhaps a little before that. You have keep in mind that we are going to be closing the transaction. We're not in the saddle as yet. There are a majority of the CPs as per schedule have been done. The rest are also on schedule, but till the last one is done, that's the time we'll be able to share more details about it.
Okay. And my second question is on the timelines of some of the upcoming hospitals. So apart from Dwarka, you've guided for 3 other hospitals getting commissioned in the next 12 to 15 months.
That's right.
Mohali, Nanavati, and Gurgaon. But when I look at the capex, project capex specifically, we are tracking a bit lower versus our guidance of 900 crores for FY24. We are at around 300 crores 9 months of FY24. So are we still expecting these 3 hospitals other than Dwarka to get commissioned in FY25?
No, absolutely. So Dwarka, which is getting commissioned, do keep in mind it is off our books because this was the asset-light model, right? The developer is investing the money, whereas we are bringing the medical equipment in place. So we've not, the entire 300-bed hospital is not, and the hospital is complete in all respects. I mean, we are right now in the phase where we are doing the finishes to the hospital and, sort of whatever medical equipment that we've brought in, we are implementing it. It's not going to be a major capex for us going forward either, as far as Dwarka is concerned. It was never meant to be because of the asset light, we're essentially paying a lease amount for that, right? A yield of, I think, 7.5% or something like that. It's a 6-year contract for the land and building, a finished land and building of 300 beds. As far as Nanavati is concerned, we've already built our 3 basements and we've come to ground level. Now, this is where things start speeding up. Do keep in mind, the first part of construction is really the superstructure, which doesn't really cost that much money. I mean, if you were to, it typically costs 1,500 to 1,800 rupees a square foot. So if you're building even 1 million square feet, then you would have spent like 120 crores just doing the construction, right? Which is superstructure. Real money is spent at the latter half part of it when you go into finishing, when you go into interiors and so on and so forth, when you bring into the high side, low side, equipment, lifts and so on and so forth, air conditioning and all of that. So I think everything, as far as the payments is concerned and this thing is concerned, is on schedule. So I would not look at that as the payments are always lumpy towards the end. So I would not look at that as a surrogate for completion of project, at least at this stage.
Okay, got it. Last one with the permission. A slightly broader question. When I look at the Saket complex, currently, if I understand correctly, we have around 800 beds there. And in the next 3 years, we're looking to add close to 800, 900 beds, and we have plans to add maybe 500, 600 beds beyond FY28. So that's almost 2,000 beds in almost a single location. It's kind of unheard of. So can you share your thought process behind such a large number of beds at a single location? How are we going to differentiate and how do we plan to, what is the strategy to ensure that there is no overcapacity situation in that location?
So firstly, the Saket complex is pretty much tearing, it's the main flagship as you're aware, right? I mean, so we are pretty much tearing at the seams as far as Saket is concerned. We've added, in a place like Shalimar Bagh, we added about 40-50% more capacity, which was then what was present there. And, within the first month or so, our capacity occupancy went up by about 80-85%. My belief is that, and we have collectively very strongly believe that if we were, so this 1,000 beds or 800 beds or 900 beds that you're speaking about is not coming all together, as you may appreciate. First, the 300 odd beds come into play. My belief is when you add 40% capacity on top of this, on top of the current sort of capacity of 770-800 beds that we have, that will be more or less instantly taken up. Right? I mean, you're going to have very quick sort of occupancy of the first 300 beds. And very soon, let's say very, very soon thereafter, you're going to be ready for the additional capacity. Like in Shalimar Bagh, we already run out of capacity, right? So even over here, you're going to have the same situation. So you'll require the next 300 beds. And so, what you can't do is start constructing 300 beds then and take another 3 years. You will need that 300 beds once these first 300 beds are occupied. And that really speaks for the first 3. Now then comes the last phase of, let's say, another 300 beds thereafter, right? Now, that only when this 300 beds, the second 300 beds gets occupied, okay, do you look at the last piece?
Okay.
But you will make the superstructure, which I again mentioned, it's not a major cost, okay? This is if things are going as per plan, but you can always stall. You can always, at the last 300 beds, you can always say, look, I'm completing the superstructure and the external of this thing, I'm not fitting it out. If you see any sort of softness of demand, our belief is this is a trajectory that we have over the next 5 to 6 years, you will be able to occupy all of those beds. But it does not mean that after phase 1, if you're not, let's say for some reason, okay, and which is beyond me to be honest, the first 300 beds don't get occupied, you're not going to fit out the next 300 beds. You're not going to build the next 300 beds.
Okay.
And also,
okay, so this is a base case. Do keep in mind, at various stages, at various phases, the default options. You don't build it's a hospital. We can't have a disruptive process. The infrastructure, the superstructure cost isn't a lot. Again, if you look at a billion square feet, it's only 120 crores. So 150 crores, 180 crores for that matter. I mean, that's about it, right? If it's not more than that.
Also, FY28 onwards is a placeholder, right? That's a potential. We are not investing anything for the FY28 capacity now. We don't even have the approvals from the board to spend on that, right? So that only reflects that we can build those many beds more on those land pieces.
I mean, theoretically, in Lucknow, if you look at it, it's 27 acres of land. You can build another 3,500 beds. I mean, that's the potential. So you see a potential post 28 up to infinity. It does not mean we'll be building 3,500 beds.
Yeah.
Got it. All right. Thanks, Abhay. Thanks for taking my question.
Yeah.
Thank you. The next question is from the line of Neha Manpuria from Bank of America. Please go ahead.
Yeah, thanks for taking my question. Abhay, on the Lucknow acquisition, how should we think about narrowing the operating performance gap that is there between, let's say, what Max is doing now in Lucknow, particularly since we'll continue to ramp up that bed. Is it fair to assume that we need to get to that full 550 to narrow that gap meaningfully, and it would happen over a period of time?
No, so we are quite confident that, in the next, within a couple of years, we will be able to get all of these beds, in the sort of conditions or perhaps better than what we have in any other hospital, and be able to catch up with our peers as well, and our peers over there, both in terms of, on every financial parameter, if not exceed.
Okay. But this would take a few years in your view?
No, so like I said, it should be done within 2 years.
Got it. And second, just extending the Lucknow question to a more broader strategy. Now that we have this, we'll have 500 beds. I know you said, you have land for adding more capacity, but do you see that as a market where you can have, let's say, multiple facilities? And is that something that you're looking that this could be a third hub outside of, let's say, the current 2 hubs that you have?
No, absolutely. So, I look at Lucknow justifying certainly many more healthcare facilities. UP's population is the size of Europe, and literally it's got 1.5 corporate hospitals over there right now as we speak. Besides, hopefully when we get in, they'll become 2.5. But I don't know if you've been there recently, but the level of development, connectivity, the roads, the infrastructure, the kind of focus that the city is getting, I mean, I think it's going to be a metro very soon, and just the scale of the infrastructure, the airport and so on and so forth, and the connectivity with other areas, backward areas and so on, both from rail, air, road, every which means. On top of that, the government itself has a very, very strong program that the Chief Minister Fund over there actually pays hospital tariffs for patients. So, I mean, you can imagine the entire population where the Chief Minister Fund is paying hospital tariffs for patients at the hospitals. Not the CGHS rates, not some low rates or whatever else. I mean, I think on multiple fronts, it certainly justifies more than one hospital.
And this would be through M&A, you think, or to just make it happen faster, or would you, choose a more organic approach of expanding into that market?
Unfortunately, I don't think there are too many M&A opportunities or existing hospitals in Lucknow. They are far and few. I mean, if we are able to get lucky again, like we've got in this case, of course, we'd look at an acquisition first because that's a faster in. But if not, then we look at organic growth as well. Build out.
Got it. And my second question is on, Dwarka. I think you mentioned that the unit head, key functional heads have already been appointed. Is that cost already sitting in the quarter? Because if I look at our, direct
That's right.
It hasn't increased as much in the last 3 quarters. So,
Yes, so that cost is sitting, and also certain doctors have been sort of onboarded, and that cost may also be sitting in this quarter.
Okay. So as we commission this and phase it up, you should start seeing that contribute to EBITDA pretty quickly.
That's right. Because the cost is already incurred. I mean, it's not a the biggest cost is always the non-medical personnel, right? I mean, it's